Let me begin with something important. We've reached a moment in the financial markets that many people will miss entirely, not because the signals are hidden, but because they're scattered across different systems, different geographies, and different time frames. Only when you connect them does the picture become clear. Something meaningful has changed in precious metals, and by extension, in how the global financial system is beginning to price risk and value. In the past several weeks, we've witnessed activity in Shanghai, traditionally the price discovery engine for physical silver in Asia, that suggests a significant repricing may be underway. This isn't speculation. This is observable market behavior. Simultaneously, respected voices in institutional finance are quietly beginning to discuss scenarios that, just months ago, would have been labeled fringe or alarmist. The conversation among serious investors and analysts has shifted. You can feel it, even if the mainstream narrative hasn't quite caught up. I want to be clear from the start. I'm not here to sell you fear, and I'm not here to promise you wealth. I'm here to walk you through what the data suggests, what history teaches us about similar moments, and what a thoughtful investor, whether you already own silver or whether you're considering it, should understand about this particular juncture. This matters because the financial ground beneath us has begun to move. Most people haven't felt it yet. By the time they do, the easy money will have already been made. Let me ask you something directly. When was the last time you thought carefully about what your money is actually worth? Not the number in your account, the real purchasing power, the ability to buy what you need a year from now, 5 years from now, with the same dollar bill you hold today. That's not a trivial question. For the past 15 years, most savers and investors have operated under an assumption that has been baked into the system by central banks and policymakers worldwide. That assumption is simple. Inflation will remain low and controlled, asset prices will inflate, wages might not keep up perfectly, but the overall system will be stable, policy will be responsive, and the dollar, and by extension, most fiat currencies, will retain its value well enough that you don't need to worry about holding hard assets. That assumption is now being tested like never before. In the background, while attention has been focused on equity markets, real estate, and technology stocks, something else has been happening. The debt of the world, government debt, corporate debt, personal debt, has expanded to levels that are, mathematically speaking, no longer sustainable under normal interest rates. Governments have spent trillions in recent years. Central banks have printed money at a pace that would have been unimaginable a generation ago. Inflation, which they told us was temporary, has proven stubbornly persistent. And now interest rates, which had been held artificially low for over a decade, are rising. For savers, for holders of cash, for people who were told to trust the system, this creates a problem. Your money loses value. That's not theory, that's arithmetic. Silver, along with gold and other tangible assets, represents something different. It's not a promise. It's not a claim on a company or a government. It's an actual thing. It has industrial utility. It cannot be printed. And historically, when the financial system enters periods of instability or policy confusion, people have turned to these assets for the simple reason that they hold value regardless of what any central bank decides to do. This is why Shanghai matters. This is why the conversation is shifting. The East is accumulating. Institutions are positioning. And the narrative, the story people tell themselves about what's safe and what's risky, is beginning to change. To understand why silver is moving now, you need to understand the forces that are pushing it. Let's start with inflation, because everything else flows from this. Inflation isn't simply about prices rising. It's about the purchasing power of money declining. When your government or your central bank expands the money supply, prints more dollars, or creates digital currency through quantitative easing, they are, by definition, diluting the value of every dollar already in existence. This is not a matter of opinion. It's accounting. Over the past several years, particularly since 2020, the money supply in most developed nations has expanded dramatically. The Federal Reserve's balance sheet nearly doubled. Trillions in fiscal stimulus flowed into the economy. This was done deliberately, with the intention of preventing economic collapse during a crisis period. The theory was sound. The execution raised questions. What happened is that inflation rose faster than expected and lasted longer than expected. Wage growth for some workers has outpaced inflation, but for savers, for retirees on fixed incomes, for people holding cash, the math is simple and grim. Your purchasing power is declining year after year. Now, here's where it gets more complex. Central banks responded to inflation by raising interest rates. The Federal Reserve, the European Central Bank, and others moved from rates near zero to rates in the 4 to 5% range. This matters enormously because it changes the math for every investor and every saver. When interest rates are high, cash becomes more attractive. A savings account pays you something. Bonds pay you something. The opportunity cost of holding non-yielding assets, gold, silver, becomes higher. This is why, historically, when rates rise, precious metals often face headwinds. And indeed, over the past 2 years, as the Fed raised rates aggressively, precious metals struggled. But here's the critical part that most people are missing. Interest rates cannot stay high forever if the underlying debt burden is unsustainable. Think about it logically. Governments owe trillions of dollars. Much of that debt rolls over annually. If rates remain at 5% and they have to refinance debt at 5%, their interest payments explode. Eventually, something has to give. Either rates come down or the financial system enters a period of significant stress. There is no third option. And this creates what analysts have begun calling a policy trap. If the Fed keeps rates high, the financial system is at risk. If it cuts rates, then it's accommodating inflation again and the currency weakens. There is no clean exit. In environments of genuine policy confusion or instability, people have historically turned to tangible assets, not because they're speculative, but because they're real. They don't depend on anyone else keeping a promise. They can't be devalued by a policy decision tomorrow morning. This is the backdrop against which we're watching Shanghai activity, expert commentary, and the subtle shift in institutional positioning. Another force that few casual investors think about carefully is currency dynamics. The US dollar has been the world's reserve currency for nearly 80 years. This is an extraordinary privilege. It means that when a farmer in Brazil or a manufacturer in Vietnam wants to trade with someone on the other side of the world, they often do it in dollars. When central banks hold reserves, they hold dollars. When the world needs liquidity, they reach for dollars. This creates immense demand for the currency, which keeps its value high and allows America to run deficits that would bankrupt most other nations. But this system is not guaranteed to last forever. It persists because there's no viable alternative and because America's economy, while challenged, remains the largest and most productive in the world. But the foundation has been cracking for years. Over the past decade, other central banks, particularly those in Asia, have been quietly diversifying away from dollar reserves. They've been accumulating gold. They've been developing alternative settlement systems. China and Russia have been building payment infrastructure that doesn't depend on the dollar at all. This is not dramatic, but it's consistent, and it matters. If ever the dollar loses even a portion of its reserve currency status, the implications are profound. The currency would weaken. Capital flowing out of dollars would need to flow into something. Assets that provide real value, that cannot be printed, that have been held by central banks and wealthy institutions for millennia as stores of value. Those would become significantly more attractive. We're not saying this is inevitable. We're saying that the risk of it is real, and that serious investors are beginning to price this risk in. Silver, unlike gold, also has enormous industrial demand. Roughly half of all silver consumed each year goes into industrial uses: electronics, solar panels, medical devices, and more. As the world transitions toward renewable energy, and as manufacturing ramps up in developing nations, demand for industrial silver is rising. But that's a separate force from the monetary currency force. Both are at work simultaneously. When you combine currency risk with industrial demand, and the question of whether interest rates can actually stay elevated, you get the conditions that are making institutions and serious investors begin to look at silver differently. Let me speak plainly about the debt situation because this is the root of everything else. Government debt in the United States is approaching $35 trillion. That's roughly 120% of GDP. Interest payments on that debt are now over $500 billion annually and rising rapidly. This isn't sustainable indefinitely. Mathematically, something will have to adjust. This could happen through inflation, which erodes the real value of the debt. It could happen through default or restructuring. It could happen through spending cuts or tax increases. It could happen through a combination of all of these. But it will happen. The current path is not an option forever. The same is true with varying degrees of severity across much of the developed world. Europe, Japan, the United Kingdom all carry debt burdens that are historically elevated and mathematically challenging. When governments face debt problems, they have a few tools. They can address it through genuine economic growth that expands the tax base. They can cut spending, they can raise taxes, or they can inflate away the debt. Most of the time, they choose some combination of the last option because it's politically easiest. Inflation erodes the real value of debt, which helps the government but hurts savers and people holding cash. This is why, in periods when it becomes clear that governments are going to pursue inflationary solutions, people who want to preserve wealth move toward real assets. We're at a juncture where this conversation is becoming impossible to ignore. History is not destiny, but it is instructive. There have been 4 major precious metal cycles in the modern era. The first began after the financial crisis of 2008, when central banks around the world engaged in unprecedented monetary easing. Gold and silver both entered multi-year bull markets. People accumulating precious metals during that period, not at the peak, but during the accumulation phase, did extraordinarily well. The second cycle was the period from roughly 2011 to 2016, when the Fed began raising rates and the dollar strengthened. Precious metals faced significant headwinds. This is important to remember. Not every environment is favorable for hard assets. When real interest rates are positive and rising, and when there's confidence in the currency system, people prefer to hold bonds and cash. But the third cycle, from 2016 onward, accelerating after 2020, saw precious metals re-enter favor. Not because of irrational fear, but because the combination of zero rates, massive stimulus, and currency concerns made the case for diversification into real assets compelling again. And now we're potentially entering a fourth phase, but with a different character. This one is not driven by crisis, but by the realization that the previous solutions are wearing thin, by the slow recognition that the debt cannot be indefinitely serviced, that the currency system will need to adjust, and that those who own real, tangible things are protected in a way that those who own only claims on currency are not. When we look at the historical record, these transitions take time. They're not sudden. They're usually characterized by what we might call institutional wisdom beginning to flow downward. First, it's observed by a few sharp analysts and active traders. Then it's recognized by sophisticated institutional investors who position accordingly. Then, eventually, the broader public becomes aware of it, and by that point, a significant portion of the move is already complete. Shanghai activity, combined with analyst commentary suggesting price targets that would represent significant appreciation from current levels, suggests we may be in the earlier to middle stages of this transition. That's meaningful for anyone considering their portfolio allocation. Let me explain what's happening in Shanghai and why it matters more than most Western investors realize. The Shanghai Futures Exchange is where physical silver price discovery primarily occurs for Asia. When activity picks up there, when trading volume rises, when spreads tighten and institutional flows become visible, it's a signal that smart money is positioning. In recent weeks, that activity has increased noticeably. Simultaneously, reports from researchers and analysts tracking physical precious metals flows indicate that Asian central banks and large institutions continue to accumulate. China has been quietly building its gold reserves for years. Its silver activity is less publicized but equally significant. Why does Asia matter so much? Because they are the future center of economic growth and consumption. Because they are attempting to develop alternative financial infrastructure that doesn't depend on the Western dollar system. And because they understand, historically and culturally, the value of precious metals in a way that's sometimes been lost in the Western world. When the Shanghai market accelerates, when Asian institutions begin signaling that they're building positions, it's worth paying attention. Not because they're always right, they're not, but because they're looking at different incentives and time frames than Western retail investors. They're not chasing 4-quarter earnings beats. They're thinking in terms of decades and multi-generational wealth preservation. The fact that this is happening simultaneously with expert commentary suggesting substantially higher prices, discussion of 3-figure silver, indicates a shifting conviction among serious participants. This doesn't mean it will definitely happen. Probabilities are not guarantees. But it does mean the probability is rising, and for that reason, the moment warrants careful attention. Here's the core problem. Most people filter everything through the lens of the last 15 years. That period was characterized by low inflation, falling interest rates, rising asset prices, and a strengthening dollar. If you're under 40, that entire backdrop is all you've ever known. You've learned that holding stocks and real estate is the correct strategy. You've learned that precious metals are for paranoid people. You've learned that bonds are boring. You've learned that the Fed has your back. All of that was reinforced by the data during that period. If you had simply held the S&P 500 for the past 15 years, you've done extraordinarily well. If you had allocated even a modest portion to real estate, you've done extraordinarily well. Bonds have been a drag until recently, but the overall message was reinforced. Don't worry, own equities, trust the system. That's not paranoia. That was the right approach for that environment. But environments change. The period of falling rates is now behind us. The period of moderate inflation is behind us. We're entering an environment where the dynamics are different. The question that most people haven't asked themselves is, what should the optimal portfolio allocation look like if we're transitioning into a different regime? Most people don't ask it because asking it requires admitting that the previous regime is changing. That's psychologically difficult. We're all creatures of recency bias. What happened recently seems like what will happen again. Additionally, many people have been trained to view precious metals as speculative or fringe. This is partly because gold and silver have been volatile at times. It's partly because certain groups have engaged in genuine fear-mongering around precious metals. But the truth is simpler. Precious metals are not an investment in the traditional sense. They're not a business that generates earnings. They're insurance. They're diversification. They're a hedge against the particular risks that arise when financial systems enter periods of instability. Most people don't like insurance. They find it boring. They want to see gains in their portfolio every quarter. They want to feel that sense of wealth creation that comes from owning a stock that's going up. Insurance, by definition, doesn't give you that feeling. It only becomes valuable when the event it's hedged against actually occurs. Until then, it's a drag. But disciplined investors think differently. They understand that insurance is cheap during calm periods and expensive or unavailable during crisis periods. They position when it's boring, so they're protected when it matters. This is why the moment we're in is important. Precious metals are becoming more interesting to more serious investors, but they're not yet popular. There's still room for thoughtful accumulation before the narrative becomes mainstream. That window doesn't last forever. If you already own silver, whether it's physical bars, coins, or exposure through ETFs and mining stocks, I want to address you directly. First, congratulations on thinking ahead. You've already made the decision to hold real assets and diversify away from pure currency exposure. That was the harder part, mentally. Most people never get there. Now, here's what matters. You need to be very clear in your own mind about why you hold it. This clarity will determine how you behave when things move. If you hold silver because you're hedging against currency debasement and the potential for periods of financial system instability, then volatility in its price doesn't matter as much. You're not trading it. You're not looking at it every day. You know that in a 10-year time frame, the real purchasing power of hard currency is likely to erode. You know that silver provides insurance against that. In that context, whether it trades at $30 an ounce or $50 an ounce tomorrow is almost irrelevant. You hold it because you want it to be there in 5 years and 10 years when you might need it. If, on the other hand, you hold silver because you think it's going to spike quickly and you want to trade it for a profit, you're in a different psychology entirely. You're trading, not hedging. And trading requires different discipline. You need to understand what makes the price move in the short term. You need to have exit criteria. You need to understand volatility and manage risk accordingly. Both approaches are valid, but you need to know which one you're doing because the behaviors that are appropriate for each are very different. If you're a holder thinking about the next 5 to 10 years, the current moment is interesting because it suggests that the probability of significant appreciation is rising. But the move, if it comes, may not be linear. There could be sharp pullbacks. There could be periods where progress stalls. You should not panic sell during those moments if your thesis is sound. You should actually view them as opportunities to add to your position at better prices. Conversely, if you're a trader looking for short-term profit, you need to have clear rules. What's your entry? What's your exit? At what price will you take profits? And what price will you admit you were wrong and exit? Without these rules, you'll make reactive decisions based on fear and greed, which is a recipe for losses. For most people, a hybrid approach makes sense, holding a core position of precious metals as insurance and wealth preservation, while remaining open to reducing that position gradually if prices appreciate significantly. This gives you the best of both worlds. You're protected if things go wrong, but you're not being foolish by ignoring gains if they occur. One more thing to remember, holding precious metals is not exciting. You won't see quarterly earnings reports. You won't get to tell your friends about brilliant stock picks. The price will fluctuate. Sometimes it'll be up, sometimes down. But this is exactly what insurance feels like when you're not in the moment you need it. Boring is fine. That's part of the deal. Now, if you don't hold silver, but you're thinking about it, I want to be equally direct. First, there's no requirement that you own silver. This is important. There are many ways to build a successful financial life and secure long-term wealth. Precious metals are one tool among many. If you have high-yield savings accounts, bonds, stocks in good companies, real estate, a diversified portfolio, you're not in crisis. You don't need to own precious metals. That said, if you've done the foundational work, if you have an emergency fund, if you're contributing regularly to retirement accounts, if you have basic diversification, then considering a modest allocation to precious metals is reasonable. What's a modest allocation? It depends on your risk tolerance and your outlook. For a conservative investor, it might be 5 to 10% of your portfolio. For someone more concerned about currency and financial system risk, it might be 15 to 20%. The common theme is that it's not your entire portfolio. It's a portion that you can afford to be wrong about without it destroying your finances. Here's how to think about entering. Don't go all in at once. Dollar cost averaging, so investing a fixed amount at regular intervals over time, is your friend. It removes the pressure of timing perfectly. It ensures you're buying at high prices and low prices, averaging out to a reasonable entry point. Also, understand the forms of ownership available to you. Physical ownership, coins or bars held in your possession or in secure storage, provides the security that you actually own something tangible. ETFs and mining stocks provide liquidity and lower storage costs, but introduce counterparty risk. There are trade-offs. Understand them and make a conscious choice. And understand current prices. We're not going to give you a price target. That's not how disciplined analysis works. But what we will say is this. Silver is currently trading within a range that has been normal for the past couple of years. It's not so inflated that we'd counsel waiting for a crash before buying. But it's also not at historic lows where every dollar is obviously going to be worth many more later. it's in a reasonable range where consistent accumulation makes sense. If you enter now and silver doesn't appreciate significantly for 5 years, have you lost? It depends. If you've held it for diversification and inflation hedging, and during those 5 years inflation has averaged 3% per year, then you've preserved your wealth while cash-only investors have lost purchasing power. That's a win, even if the price didn't move. That's the right way to think about this, not as a speculation. As a position that makes sense in a portfolio that's concerned about currency debasement and system risk. Let me talk about psychology for a moment, because this is where most investors fail. Markets are not perfectly rational. People are not perfectly rational. We all operate with biases and emotional responses that are deeply embedded in our neurobiology. When we see our portfolio declining, we feel physical distress. When we see it rising, we feel genuine pleasure. This isn't weakness, it's just how human beings are built. The problem is that these emotional responses make us bad at the exact moments we most need to be rational. Consider the typical cycle. An asset is ignored for years. Nobody cares. Maybe a few people accumulate quietly. Then something changes. News gets out, institutional interest becomes visible, media coverage increases. Suddenly, everyone wants to own it. Prices spike, people feel brilliant, they want to put more money in. And then, inevitably, profit-taking occurs. Prices pull back, the media narrative flips, people panic, they sell at a loss. Rinse and repeat. Most investors lose money not because the thesis was wrong, but because they bought at the wrong time, near the peak, when everyone else was buying. They didn't do their homework. They saw their neighbor getting rich and didn't want to miss out. Then, when the inevitable pullback occurred, they couldn't handle the volatility and sold near the bottom. Perfect timing in reverse. If we're entering a period where precious metals, especially silver, become more interesting to mainstream investors, this dynamic is likely to play out. People who read headlines and buy when prices are already elevated will overpay. People who can't tolerate volatility will sell at exactly the wrong time. You want to avoid being that person. How? First, make your decision now. Make it carefully. Think through your allocation to precious metals based on your analysis of the macroeconomic situation, your risk tolerance, and your long-term outlook. Write it down. Be specific about what percentage of your portfolio you want in this space. Then, execute that plan with discipline and patience, regardless of what the price is doing. If prices are low, you're getting a good deal. If prices are high, you're buying at higher prices as part of your regular accumulation, but you're sticking to the plan. You're not responding emotionally to volatility. This is genuinely hard. It requires you to be contrary to the crowd. When everyone else is excited and buying, you maintain discipline. When everyone else is panicked and selling, you maintain discipline. But this is exactly how long-term wealth is built. The biggest danger is emotional reactivity. You read an article saying silver is going to $100, which, incidentally, some serious analysts do believe is possible in a realistic time frame, though none can guarantee it. You get excited. You put a large portion of your savings into silver, then the price drops 20%. You panic. You sell at a loss. You're now convinced you made a mistake. You missed the opportunity. Don't do this. Alternatively, you can swing in the other direction. You become so convinced of the silver thesis that you lever up. You buy silver on margin. You buy calls and options betting on explosive moves. This might work briefly, but eventually, markets get the timing wrong. You get liquidated. You lose your initial capital and more. Don't do this either. Another major pitfall, you listen to the wrong voices. There are people who make their living scaring people into buying precious metals. They run ads with ominous music and talk about the collapse of civilization. They quote doom-mongering sources. They imply that if you don't buy immediately, you'll regret it forever. This is fear-mongering, and it's a disservice to thoughtful investing. The right way to think about precious metals is calm, rational, and boring. I've analyzed the macroeconomic situation. I believe there's a significant probability of currency debasement and financial system stress over the next 10 years. Therefore, I'm allocating a modest portion of my portfolio to hard assets that will preserve value if that occurs. I'm not expecting to get rich. I'm not betting my retirement on it. But I'm sleeping better knowing I have some insurance. That's the right psychology. Also, don't make this your only investment. We've mentioned this before, but it bears repeating. Diversification matters. You want exposure to productive assets, stocks, real estate, businesses. You want income sources. You want flexibility and optionality. Precious metals should be part of a broader strategy, not your entire strategy. And don't ignore the practical aspects. If you own physical precious metals, understand storage and insurance, understand the cost structure. If you own ETFs, understand the fee structure and what you're actually owning. If you own mining stocks, understand that they're equity securities with different dynamics than bullion. Each form of ownership has trade-offs. Don't be ignorant about what you own. Finally, don't become a zealot. The moment you start feeling like you need to convince everyone else that silver is the answer, you've probably lost objectivity. The best investors hold strong convictions but maintain intellectual humility. They could be wrong. It's possible. The macro picture could change. Governments could solve the debt problem through productivity and spending discipline instead of inflation. The Fed's rate hiking cycle could trigger sufficient economic damage that they're forced to cut rates further, which could delay the timing of precious metals appreciation significantly. You should hold your thesis, but hold it with confidence, not zealotry. Start with your time horizon. If you're thinking in terms of months or years, precious metals are speculative and you're exposed to significant volatility. If you're thinking in terms of decades, they're insurance and they become a much easier hold. Next, understand the macro cycle. We are likely transitioning out of the low inflation, falling rates, strong dollar environment that characterized 2010-2020. We are likely transitioning into an environment where inflation remains elevated relative to historical averages. Interest rates remain higher than they were, and there's significant question mark around currency stability. This transition doesn't happen overnight. It plays out over years, but that's the likely direction. Given that backdrop, precious metals are less attractive at times, when real interest rates are extremely high and rising rapidly. They're more attractive when rates are stabilizing, when inflation remains elevated, and when real returns on traditional assets are under pressure. Right now, we're in a period where rates have risen significantly, but there's also growing recognition that they can't rise much further without causing financial stress. Inflation remains elevated relative to what it was, even if it's declined from the peaks. The currency faces headwinds from debt and geopolitical developments. This is relatively favorable terrain for precious metals. From here, smart positioning is long-term and patient. Allocate a percentage of your portfolio that you've decided makes sense. Execute regular purchases over time. Don't obsess over the price. Don't try to time it perfectly. Understand that you're building a position that will be valuable not in months, but in years and decades. If your macroeconomic thesis is correct, this position will appreciate significantly. If it's wrong, you've paid an insurance premium to find out you didn't need the protection. Either way, you're okay. That's the framework. It's not exciting, but it works. Let me address the elephant in the room. Timing. You're hearing commentary that suggests the potential for significant appreciation in silver. You're seeing activity in Shanghai that suggests institutional positioning. You're being told that this moment is important. The question is natural. Is the move already priced in, or is there room for new capital to do well? The honest answer is that we don't know precisely. Nobody knows the future. What we can say is this. Silver is not yet at historically elevated prices. It's not at the levels it reached in 2011. It's not remotely at levels where you'd need to worry that you're buying after an epic move has already occurred. If the macroeconomic case for precious metals continues to strengthen, and if institutional and official sector participation continues to increase, there's room for meaningful appreciation from here. But it's not guaranteed. What is guaranteed is that if you don't own precious metals at all, and you've concluded that your portfolio would benefit from some diversification into hard assets, then waiting for perfect entry points is usually a losing strategy. Perfect entry points are perfectly obvious only in hindsight. The cost of missing them is often higher than the cost of paying slightly high entry prices, but actually getting in. We'd rather see someone buy silver methodically at $30 an ounce, continuing to buy at $32, $35, $40, eventually ending up with a 5-year average cost of $35, than see someone wait for a crash that might never come and miss the entire move. The probabilities, as we see them, favor a period of time where precious metals become increasingly interesting to more investors, where prices appreciate, and where those who positioned early and maintained discipline do well. But again, probabilities are not certainties. There are scenarios where this doesn't play out. The probability of currency-driven precious metals appreciation is high, but not guaranteed. You should position accordingly. Invest what you can afford to be wrong about. Invest with a long-term time frame. Invest with discipline and patience. That's how you navigate uncertainty. Let me conclude by bringing this back to something fundamental. Understanding. The reason we've spent this time walking through macroeconomics, history, investor psychology, and practical considerations is not to tell you what to do. It's to give you the understanding you need to make your own decisions wisely. There are many sources out there that want to instill fear in you. There are others that want to instill unbounded optimism. What you need is something simpler and rarer: clarity. Here's what we know with confidence. The world's governments are carrying debt levels that are historically elevated and mathematically challenging. They will likely attempt to inflate their way out of these problems. That inflates the real value of debts while eroding the purchasing power of currency. This has happened many times historically, and it tends to happen again when the alternative is politically untenable. When this process accelerates, people who hold real assets, land, productive business, precious metals, are protected. People who hold only currency are harmed. We are likely in the early to middle stages of this process. This is not a crisis that's crashing down tomorrow. It's a slow, grinding debasement that plays out over years. But it is real. The math is inexorable. It will happen. Given this, allocating a portion of your portfolio to precious metals, particularly to silver, which combines monetary qualities with industrial demand, is a rational, disciplined move, not speculation, diversification. If you already own silver, your job is straightforward. Maintain discipline, avoid emotional reactivity, be patient, and don't be tempted to panic sell if prices pull back. Your thesis is sound. Volatility is part of the deal. If you don't own silver, but you're considering it, your job is equally straightforward. Educate yourself, make a plan, execute it with patience, and don't get caught up in the emotional cycles that derail most investors. And if you're not convinced that precious metals belong in your portfolio at all, that's also a valid position. There are multiple ways to build wealth and preserve value. You don't have to own silver, but if you don't, you should be able to articulate why with the same discipline and thoughtfulness we've discussed here. The broader lesson underneath all of this is this: most financial success doesn't come from brilliant predictions or lucky timing. It comes from understanding the forces at work, positioning rationally, maintaining discipline, and having the patience to let time work in your favor. It comes from thinking in years and decades, not months and quarters. It comes from being contrary to the crowd without being foolish. It comes from preparation before crisis, not reaction during it. This is the moment we're in. Not a crisis yet, but a period where the writing is on the wall for those paying attention. The decision to understand it, to educate yourself, and to position accordingly is yours. What matters is that you make that decision consciously, with clear thinking, not reactively driven by fear or by herd mentality. The system will adjust. Wealth will be preserved by those who understand what's happening and prepare accordingly. It always works this way. And now you have the understanding you need to be among those who are prepared.